the plumber would be the payment processor. What would the electrician be? The card issuer? What would the electrician be?
Oh, gosh.
Hello, and welcome to In Control, where we learn about the finance of everything. I'm Tash, your host, and I'm also the CEO and founder of Cable, which supports the show. If you enjoy this podcast, please share it with your friends and colleagues and subscribe on Apple Podcasts or Spotify. Back in early 2020, Angela Strange from Andreessen Horowitz said that every company will be a fintech company because she believed that nearly every company will derive a significant portion of its revenues from financial services. That phrase, every company will be a fintech company, has since been used so much it's basically Silicon Valley lore, and Angela couldn't have been more on point. Starbucks holds about $2 billion in unused, preloaded cash on customers' physical and digital loyalty cards, which it can make interest revenue from. Delta Airlines made about $2 billion in revenue from credit card spending in just Q3 of 2025. And Shopify has provided more than $5 billion in cash advances and loans to its merchants since launching its Capital product. These companies are not financial institutions, but they're making incredible amounts of money from offering financial products right where consumers and businesses need them. And how do they do this? By partnering with banks in what has become known as embedded banking or banking as a service. At the same time, banks have been struggling. Consumers expect fast, slick, easy financial services right from their phone. Bank M&A is on fire right now, as I talked about recently with Joe Mancini. His prediction was that we'll see a halving in the number of banks in the US over the next 10 years. So, on the one hand, banks need new revenue streams and the ability to gather customer deposits. And on the other, companies need banking partners to enable them to offer financial products to their customers. But how on earth does all of this work? How do banks ensure regulatory compliance when a non-financial institution is offering their products? How do tech companies or coffee shops persuade banks to let them resell their products? Embedded banking, I think, is probably how banks survive the next 50 years. And so understanding how it works is really critical. And who better to learn from than Renata Caine, who leads embedded finance for Green Dot, which partners with the likes of Walgreens, Amazon, and Crypto.com. Renata, thank you so much for joining me. And I want to start by asking, when did you start working in the embedded banking space?
Oh, gosh. Well, I started in payments, and hello. I started in payments in 2005. So it's been over 20 years. We didn't call it embedded finance then, but things that we were doing were all in service of embedded finance. So it's been a long journey.
Yeah.
A good one.
A good one. Well, and
yes.
And one that has, lasted the test of time and has really become so important for banks and for other coffee shops and the like.
And
which
consumers, exactly.
Yeah, hilarious. So I want to really try to build this up, and I want to understand, how do banks actually do BaaS, or banking as a service? What do you start doing if you're a bank and you're wanting to launch banking as a service? Where do you start? And, build this up for me. What do you think about the team, the people you need to hire, the technology? Try to build it up for us from the ground.
Yeah. So I think banks may think it's simple because it's something that they're doing today. Mm-hmm. And the truth is, it looks deceptively simple from the outside, but on the inside, it's almost like the duck on the water that's paddling underneath, and it looks like it's an easy swim, but there's a lot of hard work that goes in there. Banks that are doing it correctly are treating it as a business, as a unique business with its own operating model and its own operating rhythm, if you would. They have to have, if you think about a bank just on its own, it has their operating model, governance, risk, compliance, technology, day-to-day supervision of the bank. But when you introduce these programs, you're doing that, but you're doing it and you're overseeing another entity. So it becomes even more complex because it's not the people it's a different organization that you have to create frameworks for and govern. So while BaaS is from a consumer's perspective is supposed to be simple and seamless, everything that goes into it from the bank and the fintech perspective is nothing short of simple and seamless.
Mm-hmm. And so it's this own product line. It's sort of this own business that is being built, just like if you were to launch a whole new business within a bank itself?
I think so. I think so. I think that if you don't treat it that way, it's doomed to fail, in my opinion. If you think about the core teams that you need, and you'll have teams like this within the bank, but they have to be really focused on the BaaS business. So, of course, you've got your sales and your marketing and your go-to-market teams. They're the ones that are talking to the fintechs. They're the ones that are sourcing the partners. They're building out what is it that the bank can do for the fintech in order to bring this unique product to market? They're negotiating commercials. They're doing all that. Eventually, they're after contract, they're handing it over to a relationship team. So none of that is new or novel to a bank. They have those teams today. But where it gets interesting is, your risk and your compliance team, your BSA, AML, legal ops, tech, like the list is long and it sounds heavy because it really is. All of those teams have to be in service of building kind of a muscle or discipline to build these processes for a fintech and then find ways of managing and overseeing and making sure that they are an extension of the bank, essentially.
Interesting. So in a bank, normally you would have a chief compliance officer, a BSA officer, you'd have a chief operating officer, a chief financial officer. Do you literally replicate all of that in BaaS, or do you have somebody in BaaS who reports to those people? How would you structure it if you were to start it today?
Yeah, so I think if it's a traditional bank, yes, I think you're going to have, whether it's double the people, I don't think that that's necessary, but certainly you're going to have people that are going to be focused on the BaaS programs. But I think actually the unique bit here is the fintech actually has those people. And you're going to have the relationships between the bank and the fintech at those levels. They need to have someone that they go to that they feel like, if I'm a chief compliance officer, I want to feel that the fintech understands what I need to deliver and what I need to show from a compliance perspective. And you can't just teach that to someone at a fintech. It has to be someone who really understands your language and has been in your shoes. So it's less about replicating those roles within the bank. It's replicating those roles within the fintech.
Oh, interesting. And so then the bank's banking as a service area or arm becomes more of the sort of communication and the management between the bank's expertise and the fintech's expertise.
That's correct. Yeah, I think the bank is taking this position of, they're going to do diligence on the fintech themselves, but then they have to design like oversight frameworks and monitoring how the fintech is doing TPRM as an example. Like they need to create the guardrails for the fintech and then make sure they stay within them.
Yeah. Okay. TPRM being third-party risk management for those who don't know that acronym. Yeah. I keep being
told
to
forget that one.
I hear. Well, doesn't everyone? I keep being told off on these for not explaining the many, many acronyms that we have in the finance world. So
yes.
So let's say you've got the right people in place and you found a fintech that you want to work with. What technology needs to be in place to actually make it all work? Like, what is the bank actually doing for the fintech?
So there's so many players in this, and you can have a whole host of players that do bits and pieces. The analogy is like when you build a house, you have a contractor, and the contractor subs out all of these different things for you to have this beautiful house in the end. It's almost the same thing. There are players, self-servingly, I'll talk about Green Dot, that offer, the whole suite of services. They are your contractor, but because they can do it all themselves, right? Some of the fintechs decide they want to be their own contractor and they want to take pieces. They want to take the best of the best and build their own, if you will. Ultimately, the bank has the deposits. The bank is risk and compliance. The bank doesn't have to be the ledger, but has to know where the money is. And I talk about acronyms. I'm sure we're going to start talking about FBO versus UBO. And I can explain the for benefit of accounts versus underlying beneficial ownership accounts. That's the bank's role. But there are lots of players. There's processors, there's program managers. There's lots of players you can stack in between. And the tech infrastructure today is there's just so much to choose from, and you can layer on, or you can simply find a one-stop solution. There's so many ways to build this.
Cool. I want to get super in the weeds here. And yes, we are going to talk about FBO and UBO, and I will, I won't. Renata will explain what all that means later. Let's start with, you mentioned like deposit. So in the Starbucks example, in the, I don't know, like Amazon has a credit card example, in the Walmart card example, fundamentally, a consumer who is going to Starbucks, going to Walmart, going to Amazon, they want to be able to pay for something using this card that actually is linked in their minds more closely to the brand. And so they are either loading money onto the card or they are using a credit card, and the money then moves from the brand, from the consumer to ultimately the bank behind the brand. But does it technically go through the brand? Like, how does the money actually flow?
No, I mean, the money shouldn't go through the brand. That's the whole point of having the bank, right? And then there's the fintech. So you've got a brand, you've got a fintech, and you've got a bank. In some cases, the fintech and the bank are the same. So in your, we could just use Amazon example. They may have cards in the wild. Those are issued by a bank. There could be savings accounts linked there. There's DDAs, demand deposit accounts linked there as well. It doesn't go through the brand because those brands, they don't have money transmitter licenses. They don't want to be the bank. They're outsourcing this to the fintech, to the bank, or both, in order to have this product in market.
Interesting. So when you say fintech in this example, you're meaning a technology company that might issue cards for the bank, or a fintech, a vendor that might enable the onboarding of new customers for the brand. Those sorts of players, right?
Yeah.
Okay.
Exactly.
So if I'm Amazon and I am wanting to enable customers to have some kind of deposit account that I can then expend money and save money and earn interest, that it feels like an Amazon product. Behind the scenes, then I'm working with a fintech that can help me onboard those customers, fintechs that can help me maybe issue cards and
they're the
move
technology,
the money.
They're the regulatory, they're all the bits and pieces. Sometimes that fintech is the bank. Sometimes that fintech requires a sponsor bank. So that's why there's all these players in the mix.
Okay.
At the end of the day, the brand wants to bring a product to market that a consumer is going to want to use, that is frictionless, that doesn't cause issues, because this brand has a good, trusted relationship with this consumer, and they don't want to introduce a product that might jeopardize that relationship. What they are trying to do is bring products that make that relationship stickier and, hold that consumer longer. And on the flip side, all those deposits, all that interchange, those are ways in which the brand can also find, different sources of revenue.
Interchange being the money that you can make when people actually use your card.
That's right.
And so oftentimes that is split between the brand and the bank. Is that how they make money from that?
Exactly. There's, it depends on how much the brand is doing versus the bank is doing or the fintech is doing. There's typically lots of hands in the jar looking to get a split of these funds. And depending on the responsibility, and I'll go back to risk again, who's responsible for, the KYC or of the customer, that might change economics. So there's all these different levers at play that end up being what becomes the economic package for the program. But ultimately, lots of players to bring these programs to life.
Interesting. And so a coffee shop like Starbucks, they are wanting their consumers to load these wallets, because then if you're going for coffee, you've already got money on your Starbucks card. You'd be like, well, let's just go to Starbucks, right? That enables that stickiness that you're talking about. Really, that card then is just a total front, because when a customer, let's say I want to load my Starbucks card, I bank with SoFi. Let's say that Starbucks was using Green Dot. really the money just goes from SoFi to Green Dot. Is that right? Through some kind of payment rails behind the scenes?
Kind of. Starbucks is a difficult example because they're like the gold standard. What they have built is amazing. Like they've taken consumer funds and they're sitting on them, and you may load $20 and use $6 and then forget that it's there for 2 years. So it's brilliant what they've done. But in your example, yes, if there was, the bank and the fintech behind it, yeah, those would be the players. There's so many examples of this, and some brands have done it so well, Starbucks being, in my mind, the gold standard.
Yeah. Okay. And so then you mentioned like the bit that the bank does. They might issue cards. They might provide some of the services. You mentioned they might be the ledger, but they don't have to be. Explain to our listeners like what a ledger is and why the bank would or would not be the ledger for these fintechs.
So ultimately, I'm going to go to the FBO UBO example, if that's okay. Can I jump there? Because I think
explain what those mean.
It's a good package. So FBO is for benefit of, and UBO is underlying beneficial ownership. These are just account types. The structures are super misunderstood in the industry, I believe, but FBO is a single pooled account at the bank. It's owned by the fintech or the brand. The money in there is fintech or brand. And the bank is holding those funds for the benefit of the end users. So it's important to understand the differences here. The bank holds one master account in this example. The fintech maintains a subledger of individual user balances. So when I said the bank doesn't have to be the ledger, they'll always be the ledger. They're always going to know how much money is in there. But sometimes there's another ledger. It could be a mirror ledger, a subledger. People call it all sorts of different things. But in this FBO structure, the end user they're not direct customers of the bank. I think that's like the biggest key here. And the KYC or AML is performed on the fintech. It's performed by the fintech, and the oversight of that fintech is provided by the bank. So this is a really common way that like neobanks and wallets bring these programs to life. And the reason they like this structure is because it's fast onboarding. It's flexible product design. The fintech really gets to control the user experience. But on the flip side, it's higher regulatory scrutiny. The bank must ensure that the fintech's KYC, AML, all of that is very robust. And it's harder reconciliation, and it introduces more opportunities for error. That's why there's been such a spotlight on FBOs in recent years. On the other side, with the UBO, each end user, so the consumer at the end, like there's a brand and you've got your customer, the consumer is the actual individual account owner. So they're the customer of the bank, and the bank performs KYC directly, and the end users, they're bank customers, even though they're coming in through the brand or the fintech, they're bank customers. And I would think about the fintech or the brand as kind of like the service provider, not the account owner. So it's the pros and cons are the exact opposite of FBO. So the pro is lower regulatory risk for the bank because they're doing it. Clear FDIC insurance, easier reconciliation. But the con is slower onboarding and more friction, and the bank has a much higher operational load. So when you think about economics of these things, when it's a UBO, the bank does more for that account. So they do more for that program, and that all gets calculated in a deal model.
And that must impact the cost of the core as well quite significantly. I did an episode with Stacey Bishop about core banking systems, and we were talking about how expensive these can get. And if each individual Starbucks cardholder in this example got their own account at the bank, they would presumably have an account on the core, which is significantly more expensive.
Yeah, and that's why early days, most of these early BaaS programs were FBO structures.
Interesting.
After recent enforcement actions, like we're definitely seeing a shift to UBO or even hybrid models. But I actually don't know if we look back to 25 or when we're in 27 looking back at 26. I wonder, if we're seeing another shift given, current regulatory environments.
Yeah. Okay. Was the Evolve Synapse debacle that ended in a cease and desist order for the bank and money for consumers still missing? Was that because it was an FBO that Evolve had set up for all of these customers?
You have to believe that's the case. I actually don't know, but I assume that is the case.
Yeah. Okay. Because then really the bank is saying, we've got all this money, but the source of truth for who this money belongs to is down to you, fintech.
Yeah, so these two ledgers were out of sync at the end of the day.
Can you provide FDIC insurance if you've got an FBO?
Yes, you can. Sorry, my words aren't coming out of my mouth, but yeah, there are FDIC options. It's clearer when the end user is the customer versus it being the pooled FBO account.
Yeah, and that feels like it would be difficult to keep track of. So for FDIC insurance, obviously there's a maximum that can be covered, $250,000, that if a bank goes bust, then the government, the FDIC specifically, will pay back consumers up to $250,000 that they kept at this bank. But if
harder to prove it in an FBO structure, so there's far more complexity.
Yeah, and harder to keep track of how much money you've got for each individual customer.
That's right.
Okay. That's interesting. So if we think about some of the examples that Green Dot specifically works with, which are really getting into the sort of interesting embedded banking space rather than the sort of neobank, challenger bank, like consumer-facing fintech space. So thinking of an example that you work with being like Intuit or somebody. You work with Intuit? Have I got that right?
You do.
Okay, cool. Got that one right. Excellent. QuickBooks. So in that example, like that presumably is more FBO because you're not providing individual financial services for each person. Rather, you're helping the company perform their service to the consumer. Is that right?
There's some examples of companies who work with SMBs, and the end customer is an SMB. So in this example that we're talking about, that SMB actually is an account holder with Green Dot Bank versus being a pooled. So they actually leverage Green Dot as the bank, and each small, medium business has an account.
Got it. Okay. Cool. That makes sense. All right.
And as a side note, in the case of Green Dot, we do both. More commonly, it is UBO.
Interesting. Okay. That's super interesting. So the other thing on the technology side that I want to understand that I don't feel like I have a really good grasp of right now is there are so many technology providers in this space that you can use if you are a bank wanting to work with a fintech. And they all seem to do slightly different things and call themselves slightly different things. So you could work with a program manager that is just another intermediary between the bank and the fintech that actually seems to do the onboarding, do the know your customer checks, do a lot of the consumer facing work for the fintech. And then you've got just card issuers and payment processors. I'm thinking more like a Lithic model or a Marqeta model. Talk to me about the pros and cons. If you were just a regional or a community bank wanting to start getting into this space, like what are the pros and cons of all these different players here?
Yeah, so it's so complex, but I actually love this and I love this topic. I spent over 4 years at Marqeta, so understand that business really well. And you could be both in that example. You could be just a processor, or you could be a processor, issuer processor program manager. So if you're a bank thinking about who you want to work with, it really depends on what the brand needs. So the brand may want to not do any of the onboarding, not do any of the KYC, not do any of the, have any of the burden of, regulatory or compliance. That's when introducing a program manager makes sense. So you could choose a program manager and you can choose a Lithic as an example. And now you've got 2 players that are helping you bring these programs to life. And there's a bank. So now there's 3 players. In the example of Marqeta is the issuer processor. They also can be the program manager. So now the brand can just choose them. So more one-stop shop with the bank on the other side.
Okay.
I'm going to plug Green Dot in here because with Green Dot, it's the issuer processor program manager and the bank in one.
Oh, okay. Interesting. And that's
So
the
all these different players do all these different things. And so back to the home building example, you can choose to be a contractor and have lots of players, or you can, have 2 or 3 or 4.
Yeah. So the plumber would be the payment processor. What would the electrician be? The card issuer? What would the electrician be?
Oh gosh. The plumber would be the payment processor. I would say that the program manager is you're doing all of your tiling and all the like the stuff that makes it a home. It puts it all together.
Yeah.
Electrician. I think electrician is a little bit like the plumber example. It's like it's foundational. Like you can't have a house without it.
Yeah. Who's the architect? I guess that's the fintech. They want this stuff and they're kind of just like
the fintech,
designing it.
Working with the brand, deciding what it is they want to have in market.
All right. So I want to get on to understanding the finances behind all of this.
Yes.
At a high level, like why would a bank want to do this? What are the ways to make money from this? Does it make a lot of money? Is it small margins, big margins? Talk us through all the different ways that banks can make money from this.
Yeah. So there's a variety of sources. So there's interchange revenue. So we talked about that's every single time you swipe a card, tap a card, any of the ways in which you do a transaction, there's interchange revenue that's flowing through. So banks are making interchange revenue from the network being, Visa, MasterCard, or similar. So there's a piece of that can get shared with fintech, can then get shared to the downstream partner or brand. So again, lots of hands in the cookie jar wanting a piece of this. In the case of having deposit accounts, not as common, but there's deposit spread that can be had. So when the money is sitting there and making interest, depending how much is there and how long it sits there, a bank may choose to share some of that deposit interest revenue back with the fintech or the brand. I say that it's not as common because there's so much complexity to these programs. And so when the bank is taking ownership of program management, it eats away needing to offer that as a benefit, as a revenue stream. But again, there's so many different revenue streams that there's all these levers to pull, if you will. Mm-hmm. Then there's program fees, and the list of program fees. There's account creation fees. There's KYC AML checks, there's transaction processing fees, there's transaction monitoring fees, there's ledgering fees, compliance oversight, or just general program management fees. So there's all these places where you can generate fees. It can be super complex. It can be super simple. It really just depends on the program that you're building.
Interesting. And so is it true that in most cases, the fees that a bank would charge a brand or a neobank fintech, are those fees generally greater than the increased interest and interchange that can be made from the deposits and the card swiping?
Is it greater?
Yeah. Which is the biggest bucket of revenue for a bank? Or does it totally depend?
It depends. Like you can have programs that offer like high interest rates. And so you're seeing consumers dump a lot of money into those accounts and not actually transact. So in that case, there would be no interchange revenue, but there'd be interest revenue. You could have programs where they're barely, like the money gets into the account and they're spending it right away. So there's no interest revenue, but it's high interchange revenue. So that's why I'm saying like every single one of these is unique and slightly novel, unfortunately. So every single one you sit down and you try to figure out who are they supporting? Like what consumer are they supporting? Are you talking with someone who is supporting, low medium income, or are you talking about someone who is supporting like generational wealth? Because the spectrum is really different.
Interesting. And so as a leader in this space, is your goal often to diversify your portfolio of fintechs to mitigate the risk of suddenly interest rates drop, or suddenly people are not able to spend because they're stuck at home because of COVID or something? Are you trying to get one of each type of fintech? Is that really appealing?
Yeah. So personally, yes. And not only for all the reasons that you said, which I won't regurgitate, but those are all the reasons why you should diversify. But also think about the products that someone might use at this end of the spectrum when they're like entering, like trying to just start building their credit. If you have products in market that, are across the spectrum, you can graduate this consumer through there and hold this consumer for a really long time. Ultimately, the longer you have these customers, the more amount, the greater your return on them is, right? So you want to make sure that as they grow and as their financial wealth grows and as they get more knowledgeable, that you have the products to serve them.
We have got all the revenue, the sort of fee, the revenue generation. That is the program fees, interchange, it's interest sharing, maybe there's some deposit lending out. What about the costs? I mean, you mentioned the team, obviously. You mentioned some of the compliance checks that the bank will have to do on the fintech, although that seems like it's maybe covered by fees. So what are the other costs for a bank associated with embedded banking or banking as a service?
So those are the major buckets. There's obviously the technology costs, the accounts on file, however they think about the different cogs to just manage the bank. In my opinion, it's hard to make money here.
Oh, yeah. Okay.
Absolutely. It is a scale game, right? You have to have lots of scale to make this profitable. And that's the same for the brands. Like you see brands go into market with a product, and if it doesn't catch on, you see it go away fairly quickly. You see a year later, they're sunsetting it. Scale is kind of the name of the game.
That's really interesting. Okay, so if a bank wants to get into this area, having one or two fintechs is probably not going to cut it. You need to be getting to, what is it? Is it 10? Is it 20 fintechs or brands?
Yeah. I don't know if it's a brand number or the underlying customer number. Right?
Or the volume of deposits.
The velocity of deposits, the interchange, all of that. I think that's actually the key.
Interesting, because Bancorp for a very long time, Chime was one of their only brands or fintechs, but because it was
Chime was so successful and had so many people come in that was why you could have one fintech.
Got it. Okay. And so for the fintechs themselves, how are they making money? This feels like a pie that is just being shared out by more and more people. How do fintechs actually make money from this?
It's the same thing. So if you think about the bank sharing interchange with the fintech, the fintech then has to share interchange with the brand. If there's a fintech between the bank and the brand, right? So if you have this multiplayer scheme, everyone's taking a cut. So sometimes your cut is bigger or smaller depending on your role in bringing that program.
And so is interchange the only fees or the only revenue that the brands can make, or do they also get to make revenue from interest or from, do they get to charge fees? Is that totally up to them, I suppose?
Well, yeah. So the brands can charge a consumer fees. The brands can charge for wires, for, real-time payments. There's all sorts of different levers that brands can put out there. Again, they want to have something that goes into market that a consumer wants and the consumer feels like it makes sense to use. So they're very price conscious. But yeah, the more that goes back to what we were saying, the more players involved in bringing a a BaaS program to life, the smaller the cut for everyone along the way.
Yeah, which is why presumably Green Dot has done everything, because it seems much more attractive for the brands to just have one person to share those fees with.
Yeah. That's right.
Okay, that makes sense. What am I missing in terms of the revenue and the costs for banks or fintechs or brands in this world? Like, what have we not talked about?
The costs. I mean, it's expensive to acquire customers. So from a brand perspective, those who have an embedded base of loyal, trusted customers, those are the ones that should bring an embedded program to life. The ones who don't have that, it's just not worth their time, in my opinion.
And that's why the likes of, Walgreens and Starbucks and Delta Airlines, it makes a ton of sense for them. And I've recently recorded an episode with Susan Ehrlich from Core VC about credit cards, because she's run credit card programs pretty much everywhere. And she was talking a little bit about branded credit cards. And there are also sort of aggregated brands. So if an individual brand does not have enough customers to make it worthwhile for the brand or the bank to give them an embedded program, can that brand get together with 10 other brands who it turns out the same sort of consumers shop at all of them, and bring a credit card for all of those brands to life? That's
genius. I mean, that's one way of cutting your costs down and being really smart about doing it. Yeah, I think that's how people should be thinking about it.
And talking about like credit cards and lending in that example, how does lending differentiate from just taking customer deposits for a bank in this world? So does Green Dot do both lending and deposits, or just one?
No, we're not. We don't do any credit lending at this time. So I've worked at a lender before and offered credit in market. It's a different model. But yes, you make money on having customers take credit, and you're charging them fees every month. So again, every new revenue stream means there's pieces to build a program with, but more that you're giving back to brands and fintechs.
Got it. Okay. And so I guess the final question I have is, who is BaaS sustainable for? Who should be doing this? Who should be trying to build embedded finance programs?
So we did a study. It was late last year, and I found it really interesting because more and more companies are getting comfortable with this idea of BaaS and embedded finance. So it used to be that only the enterprise players were willing to take this chance, and because it's an investment. But we're seeing that more and more, like kind of down the chain, companies are interested in this because of the fact that they have that embedded customer base that is loyal. So that to me is the key. It's no longer the size. So we used to always think big brands that, consumers know. No, it might be a brand that you just trust. Those are the brands that are going to win and should be thinking about it. But what the study showed is that we're definitely going down market. There's definitely interest outside of the enterprise brands.
Yeah. And on the bank side, what kind of banks should be doing this?
So I believe banks of all sizes should have an embedded finance strategy. So even the largest of the banks should be finding ways to leverage the technology out there if their technology can't do it, and finding, partnering with program managers to be able to put this together and bring it to the brands. Because if they don't, someone else will.
Yeah. But to your earlier point, if they're going to do that, they really need to be thinking about huge scale, and they need to be fully in and not kind of dipping toes.
Which is back to like our very first topic in this conversation. Like, it needs to be a business within the bank. It has to have its own operating model. It has to have its own rhythm, and you have to have a clear investment and not expect something back very quickly.
Yeah. Got it. Awesome. Well, Renata, thank you so much for helping me understand how embedded banking and banking as a service works. I really appreciate it. And if you enjoyed listening, please share this with your friends and colleagues and subscribe on Apple Podcasts or Spotify. And I will see you next week.